Dropping $5,000 to $7,000 to pay off your credit card is possibly one of the worst things that you can do if you can get a higher return somewhere else. I know I'm gonna catch a lot of heat for this video, but okay, the average, what, 24% interest rate with a credit card? What if I tell you you can make 96% return on your investment by investing that $5,000 to $7,000 instead? That's why in this video, I'm gonna show you what to do with that money instead of paying off your credit card. Before I show you why you shouldn't pay off your credit card, hit that like button for me if you're heated, if you're actually excited to know this information. So let's just say in theory, you have $5,000 or $7,000 worth of credit card debt and you have $5,000 to $7,000 in your bank account. So that's the scenario we're gonna be going over, because please, like, hear me out, because I know I'm gonna catch so much heat for this. Don't do it, because think about this. And this is kind of what we're gonna roll into. In my last video, I kind of touched on it already. Instead of using that $5,000 to $7,000 to pay off your credit card, use that money to buy a duplex and house hack. Now, there's a lot of stipulations with this, right? Because disclaimer, you might not be able to actually get that loan for that duplex because you have so much credit card debt, your DTI is actually too high. That's not what I'm here to talk to you about. If all the scenarios work out for you and you have $5,000 to $7,000 with credit card debt, and you have that in the bank, use that money to buy a single family home, duplex, triplex, or fourplex, because you can get a residential loan for 3.5% to 5% down. Meaning, if you buy a single family home, you want to rent out the rooms. This is house hacking in a nutshell, right? So if you want to buy a duplex, you live in one unit, you rent out the other one. If you triplex, you live in one unit, rent out the other two. You get the idea. But with a residential loan, you can put 3.5% to 5% down using the FHA loan. So with that, if you buy a duplex and it's obtainable, like I literally get emails for duplexes anywhere between about $50,000 to $250,000 every single day, literally every single day. It's possible. So with a duplex, if you buy a duplex for $150,000, on the high end, you put 5% down. That's $7,500. At $7,500, instead of paying off your credit card, you can use it to buy a duplex. Now here is where it gets fun. So with that mortgage, your PITI, meaning your principal, interest, taxes, and insurance, is going to be roughly around $600. That's going to vary between, city by city, state by state, whatever, because your property taxes and your insurance is going to go up depending on where you live in the country. But let's just say for Oklahoma City, your mortgage, your PITI is going to be $600-ish every single month, depending on how much you put down. But in this case, we're putting on $7,500 because we're getting the 5% down. So your mortgage is $600 every single month. But let's just say for this scenario, you can actually buy this duplex and you can rent out the other side for $750. Well, now you're not necessarily making $750 because you're going to be taking out for expenses and all that. So you might just break even, but you're not. You're not really breaking even. Why? Because you're living rent free, like rent or mortgage free. That's the power of house hacking. So that's $600 that you would be spending renting out a house or whatever it is, or spending on a mortgage. You can now save that every single month. And that's the power of it, because think about this. Here's where the 96% return on your investment comes in. $600 times 12, $7,200. You just almost made your entire down payment back in 1 year. Do it again and again and again. Now, again, here's a little disclaimer. With the FHA loan, you have to stay in the property for at least 1 year. After that 1 year, there's nothing that says you can't move out and do it again and do it again and do it again. And you're living rent free. And now whenever you move out of the previous unit, you're putting a tenant in there. So you're still making money on that unit while you're still living rent free. So if you do this in 5 years, like my last video, that link is gonna be in the description down below. But in my last video where I talk about, becoming wealthy in 5 years instead of having to wait until 60, you could literally do this in 5 years. Because if you're saving that $600, living rent-free, mortgage-free, and you're renting out the previous units, $750, you're making that now. You're making $750 every single month. After this, you can pay off your credit card, whatever, but you want to buy assets to pay for your liabilities. So meaning, do not buy a car. Do not buy an expensive car without having an asset pay for that. And an asset is not your job. So do not use your job to pay for your liability. What do I mean by that? If you're house hacking and you're saving $600 a month, don't do anything. Start saving that money. If you get to 5, 6, 7, 8, 10 units or 10 duplexes, now you can maybe start paying, using your assets, the money that you are getting from your cash flowing properties, to pay for your liabilities. And one of those liabilities is your credit card. You just want to do those things first. Now, okay, you put yourself in credit card debt. That's the first thing you actually did. But now you want to buy assets to pay for that. Why? Here's something really juicy I want to talk to you about. Let's just say for that $7,000 over the course of the year, you got what, $1,000 worth of interest payments on that now. Whatever. Why does that matter? Because if you, let's just say you spent that $7,000 on that credit card at the very beginning and you didn't buy a house hacking property, now you are having to wait in another year. So you spent it on the credit card. Okay, credit card's blank. You're having to wait another year to save up that money to actually buy the duplex. Then you're gonna have to wait another year to move out, get another duplex. You have that money saved up again. You have the $7,000. So basically in 2 years, you just had to wait 2 years for nothing. When you could have did it, if your situation works out and you have good credit, blah, blah, blah. But if that situation works out, then you want to buy that asset because you don't want to wait those 2 extra years to start actually building up your cash flowing properties. So I'm not saying credit card is good debt. It's definitely not good debt. But if you have the money to invest it for a higher return, you should be doing that. So again, like I talked about in my last video, if you're earning 10% a year on an index fund, it makes absolutely no sense to put that $7,000 into that index fund, earning you 10% a year whenever your credit card is charging you 24% interest a year. That's a negative 14%. You're still in the hole. Whereas when you house hack, you're getting a 96-ish% return on your money versus 24% going out. You are making 72% on your money even after the interest on your credit card. I get it, credit cards, they're stressful, right? They're stressful, you can see them, like you can literally see your balance going up every single month. I get it, it's stressful. It's taking up mental space, it's creating stress. I get all that, I really do. Suck it up for a year, suck it up for 2 years. Guys, it will pay off for you in the long run, so think about it. Whenever you buy the property, get your cash flow, pay off the credit card. Wow. And now you still have your asset that you're still living rent-free on. Then you can actually move out after that year. So final note, don't pay off your credit cards if you can get a higher return somewhere else. Now there's gonna be videos popping up all around here that I picked out specifically for you to bring you even more value than I did in this video. So go check those videos out. Until the next video, I'm out. See you.